As a trader, you've probably heard about sector rotation, finding stocks that are strong in strong sectors. My guest today is Corey Rosenblum to talk about how to find good opportunities using sector rotation. So Corey, first of all, let's define it. What is sector rotation?
Sector rotation is a theory put forth, discussed by Sam Stovall, Martin Pring, John Murphy, a lot of the older school technical analysts that we look for today for advice and for these kind of strategies. And it's a concept of integrating the business cycle with economics with stock market performance. And the theory is that stocks tend to lead the economy at major turns. And so the stock market will turn down ahead of a recession or will turn up ahead of a recovery. So that's the theory. But then again, sectors in that performance or sectors in the market itself, the market is not just one initial thing. It's a collection of sectors, a collection of industries, and of course at the core, a collection of companies. And they all represent different facets of the economy. Finance. We have different things in. We break down the sector rotation model into aggressive sectors, those that perform well during a recovery, or conservative or defensive sectors, which perform well during a downturn. And those would be examples of healthcare, consumer staples, utilities. And just for example, the ones that do well during a recovery would be financials, technology, consumer discretionary.
All right, so do you recommend using ETFs now that you can kind of go ETF by sector to trade the entire sector, or do you recommend buying the strong stocks in that sector? What do you do?
There are two ways to look at that. As traders that don't have a lot of time to focus on lots of analysis if they have a full-time job or they just don't have time to do the market, an ETF model, you're looking at just the 9 major Amex sector spiders, or XLK for technology, for example, XLF financials, etc., XLI industries. Those industrials, those would be what they would look for performance, and it's a relative performance to the S&P. So in terms of the aggressive or conservative, which groups are outperforming relative to the performance of the S&P? During a recovery, during a bull market, those tend to be the ones that are leading. And that's a good thing for the incentive economy. If technologies, if consumer discretionary, retail, etc., materials, if those are outperforming the risk-off sectors, that tends to show investor preference for risk. And that suggests further appreciation in the stock market. But traders who have more time, they can go and dig a little beneath the data, go back in the numbers, they can find fundamentally strong stocks in fundamentally strong sectors. And it's a little bit way to get a better edge because individual sectors are made up of groups of stocks. Some of them are outperforming, some of them are not.
All right, as we head into the final part of the second half of 2012, what sectors do you think are strong here and what do you expect?
Well, in the middle of the year, we're having a little bit of a turn down. So we're seeing strength in terms of, we're looking at sector rotation moving towards the more defensive assets and utilities and consumer staples and into healthcare. That's certainly not a good sign for the stock market. If we want to see that trend reverse though, we wish to see that almost go back to risk on. So we've had a large run up into this mid-2012. It's natural. It's absolutely understandable to have a pullback, to have money rotate, take some of the risk off, take some of the profits off, and then put that into more sectors that are defensive. Especially if funds that need to be fully invested. They can't just go into cash at all completely. They rotate money into those defensive sectors for a little bit of an outperformance. If the S&P is to fall, say 10%, maybe those sectors will fall 5%, and that will be a relative outperformance. It's still a loss of money if the stock market does continue to decline, but it is an actual outperformance in terms of percentages, and that's a lot of times what fund managers look at.
Corey, thanks for your time.
Thank you, Tim.
You're watching the MoneyShow.com video network.